Why asset managers? What's the linkage here?
Well, it's quite right. The regulators always look for the next crisis, and it's never where it's been before. So we've had, Asia in the late 80s, dot-com stocks, then US property. And the banks, as a result of the crisis, have been regulated quite hard. They're required to hold more capital. So they're lending less to companies. So what's taking the place of that, particularly in Europe, it's the capital markets. So lending money through the form of bonds. Unfortunately, other regulations that have been put through mean that the liquidity of the corporate bond market has declined quite dramatically, down about 70% since before the crisis. So you've got all this money rushing into the market when it wants to come out. That's the worry that regulators have.
So you're talking about the disconnect between the primary and the secondary market. The primary market has been extremely active, and I know we've got a board that we prepared for our viewers. Essentially, huge activity there in terms of financing, but little trading in terms of the secondary market. Now, over the last couple of weeks, we've seen a rush for the exit coming from the high yield market. Strains are already showing, aren't they? Exactly,
and you could imagine a situation in which the strains broke the primary market as well. So if you go back to the taper tantrum of May, June last year, it was very difficult for emerging market borrowers to issue bonds for that period. So this is where the regulators are worrying. The systemic risk is that companies can't get finance. If companies depend on the bond market collapses because everybody wants to sell bonds that nobody wants to buy, just like 2008 with the housing market, then you could get no new issues in the corporate bond market, and that would be a big problem.
So essentially what you do as an asset manager, you simply gate your fund, right?
Well, yes, but if investors think that they're going to see their funds gated, then they'll say, well, I'm going to get out of that fund before it gets gated. And they did suggest this for money market funds last week, the SEC. But the trouble with that is you create the very run you're trying to avoid. So if you knew that your bank was going to close next week, well, you take the money out now. So similarly, you would not leave your money in a fund which you thought would be closed for any significant period.
The trouble is, this is a lot of mom and pop investors, a lot of retail investors who are invested particularly into high yield bonds. If there is a rush for the exit, do you think it could spark a wider panic?
It might do. I don't think the mom and pop investors are the ones to worry about, oddly enough. If you go back to 2008 when the money market funds had a big run, it was institutions that did it. A lot of people who put money into bond funds do it through pensions, 401ks, and they put a bit in each month. It's the institutions who worry that they don't want to get stuck with a underperforming position, and they might pull their money out. Now, what regulators might do about this, I think there's something they shouldn't do, which is to make these money managers SIFIs, systemically important financial institutions. If they do, that'll mean having them hold more capital, which will just get passed on to mom and pop investors, and that would be bad.